Welcome to The Debate. Today, we are putting a Jamaican manufacturing titan under the microscope. We're dissecting the 2025 annual report for LASCO Manufacturing Limited, that's ticker LASM. This is a company that has, been a staple in Caribbean households for 3 decades, from the breakfast table with their powdered mixes to, the cooler with iCool water. But after 30 years, the question isn't really about their past, it's about their future.
Exactly. 30 years is a long time. It's long enough to build an empire, but it's also long enough for the foundation to start settling. We are looking at the year ended March 31, 2025. And frankly, I see a company that might be running out of steam.
And that right there sets the stage for our central inquiry. Is LASCO Manufacturing a resilient efficiency machine? A company that has just mastered the art of squeezing record profits out of a tough economy? Or is it hitting a concrete ceiling? You look at the numbers and you see slowing revenue and a drop in cash flow. I look at those same numbers and I see a masterclass in margin protection and strategic patience.
Strategic patience is a very polite way of saying stagnation. I'm here to argue that the high-growth story that investors bought into a decade ago is, well, effectively dead. They're masking a stalling top line with aggressive cost-cutting, and there is a massive hole in the cash flow statement, a 54% drop in operating cash that we just can't wave away with buzzwords like resilience.
I think you're confusing caution with stagnation. In a world defined by, supply chain chaos and geopolitical tension, LASCO just delivered its highest ever bottom line. That is not an accident. That is superior management. But let's get into the details. Why don't you open the case for the prosecution?
Okay, I'll be blunt. The headline numbers are a mirage. When you crack open this 2025 report, the first thing that hits you is the deceleration. Look at the revenue. The top line, it came in at $12.42 billion. Now on paper, that's a 3% increase. But context is everything. 2 years ago, they grew 18.6%. Last year, 7%. Now, 3%. That is a slide. In an inflationary environment like Jamaica, where prices for everything are going up, a 3% nominal revenue increase likely means they actually sold fewer units of product.
That's a heavy assumption.
It's a mathematical probability, but the real smoking gun is the cash flow. Net cash flow from operating activities, the actual cash generated by selling juice and milk, it collapsed. It fell from $3.52 billion in 2024 to just $1.62 billion in 2025. That is a 54% drop. When a manufacturer claims record profits but generates half the cash it did the year before, alarm bells should be deafening. It suggests the quality of those earnings is poor.
I hear the alarm bells you're ringing, but I think they're false positives. You are hyper-focused on volume, but you are missing the story of value. The 2025 report is a triumph of internal discipline. The metric that pays the bills isn't revenue, it's net profit. And that increased by 8% to $2.57 billion. And even better, look at the efficiency. The net profit margin expanded to 20.7%. That is up 90 basis points from the prior year.
90 basis points is fine, but...
Hold on. Let's be clear about what that means. In finance, 100 basis points is 1%. So improving by 90 basis points means they are keeping nearly an entire extra penny of profit for every single dollar of sales compared to last year. That is elite. It means for every dollar they take in, they keep nearly 21 cents. That is an efficiency engine. And this isn't a fluke. Over the last 5 years, their operational profit has a compound annual growth rate of 16.3%, while revenue grew at 10.9%. That proves they are growing profit faster than sales. They aren't just turning out volume. They are optimizing every single operational lever. In a softening market, as the chairman James Roll called it, that is exactly what you want a management team to do.
You bring up the softening market, and that leads us right into our first deep dive. Revenue deceleration versus operational efficiency. You're framing that 3% growth as some victory of efficiency. I see it as a pricing trick.
How so?
Well, think about it. We know inflation was a factor in 2024 and 2025.
If LASCO raised prices on iCool and LASCO Food Drink by even, say, 4 or 5% to cover their costs, and their total revenue only went up 3%, that implies a volume contraction. They are shipping fewer cases. Mr. Rawl himself admitted in the report that there was a softening of the market in the third and fourth quarters. You can only play the price hike game for so long before consumers switch to a cheaper alternative. You cannot cost-cut your way to prosperity if nobody is buying the product.
I think you are underestimating the power of their brand equity. In a mature market, you don't chase empty calories. You don't chase volume that destroys your margin. Yes, demand softened. That's macroeconomics. I mean, everyone felt it. But look at how they handled it. Operating profits still grew 7% to $3.32 billion. How? Because they put a vice grip on expenses. Administrative and selling expenses went up by only 2%.
2%? That is essentially flat.
Exactly. In a high inflation year, holding expenses flat is a miracle of management. It kept their expense-to-sales ratio steady at 13.7%. They didn't panic. They didn't let bloat creep in just because the top line was slow. That proves James Rowlett and his team have their hands firmly on the wheel. They are protecting shareholder value by right-sizing the operation to fit the market reality.
But at what cost? You praise that 13.7% ratio, but I look at the gross profit margin. It actually contracted slightly, down 10 basis points to 37.5%. Now, you might say, oh, it's only 10 basis points, but it signals that the cost of goods, sugar, plastic, energy is rising faster than they can pass it on. If your costs are going up and your sales volume is flatlining, your bottom line is incredibly vulnerable. You can freeze hiring or cut the marketing budget to save a few dollars today, but if you stop marketing iCool, you lose market share tomorrow. It really feels like they're burning the furniture to keep the house warm.
Burning the furniture is a gross exaggeration. A 10 basis point dip in gross margin during a year of global supply chain hell is a victory lap, not a warning sign. It shows they have pricing power. And regarding the expenses, they aren't starving the business. They are running it lean. That discipline allowed them to deliver earnings per share of 62 cents, up from roughly 0.58 cents. Shareholders are getting a raise. If that's stagnation, sign me up.
Well, let's see if those shareholders can actually spend that raise. This brings us to the elephant in the room, the thing that makes me so nervous about this stock, the cash flow controversy.
I had a feeling we'd end up back here.
We have to. It's the discrepancy that demands an answer. We have a company claiming record profitability, yet the cash generated from operations fell by nearly $2 billion, collapsed. Usually profit and operating cash flow, they move in the same direction. When they diverge this sharply, profit up, cash down, it means money is getting stuck somewhere in the gears of the machine.
It's not stuck, it's deployed. You have to explain why it's down. You can't just look at the cash flow statement without glancing at the balance sheet.
Okay, let's break this down for the listener who might not stare at cash flow statements all day. Profit is an accounting opinion. It's what you say you earned. Cash flow is a fact. It's what actually hit the bank account. When operating cash flow drops by 54% while profit goes up, it usually means you spent a massive amount of cash buying inventory that you haven't sold yet.
Exactly. It's in inventory. The chairman explicitly mentioned persistent supply chain issues and geopolitical tensions. If you run a manufacturing plant and you're worried that the ships from China or Brazil might stop coming, what do? You buy, you stock up, you fill the warehouse with raw materials, packaging, ingredients, spare parts to ensure you never have to shut down the line. That consumes cash. It's a strategic use of working capital to buffer against risk.
That is the charitable interpretation. But let me offer the skeptical one. A 54% drop in cash flow is a massive inventory buffer. It's like buying 5 years' worth of groceries because you think the store might close for a week. What if they aren't just buffering against supply chains? What if they produced a massive amount of finished goods expecting sales that never materialized? Remember the softening demand in Q4? If you keep the factory running full tilt, but the sales slow down, your cash gets tied up in unsold iCool sitting on pallets. That is dangerous. Inventory is a liability if you can't move it.
But LASCO has a history of moving it. This isn't a startup. And look at the financial fortress behind it. Total assets grew 13% to $18.48 billion. Shareholders' equity is up 15% to almost $15 billion. The balance sheet is rock solid. They can afford to carry extra inventory. In fact, in this environment, having the inventory is the competitive advantage. When their competitors stock out because they didn't want to spend the cash, LASCO will still be on the shelf.
Perhaps, but cash conversion is the heartbeat of a mature company. You make it, you sell it, you get made. When that cycle slows down and a $1.9 billion drop says it's slowed down significantly, it hurts your ability to pivot. It ties your hands. And speaking of pivoting, let's talk about where else the money went. They spent $425 million on capital investments.
Which brings us to our next point. Investment in the future versus a defensive posture. You see a company stalling, I see a company retooling.
I see a company doing maintenance. $425 million sounds like a lot, but in manufacturing terms, is it expansion or is it just keeping the lights on?
Oh, it's far more than keeping the lights on. The report details that this capital went toward enhancing automation and digitalization. They are streamlining the manufacturing process. This is how you protect that 20% net margin we talked about earlier. By automating, you permanently lower your cost of production. You reduce waste. You improve speed. You don't spend $500 million on robots if you think your business is dying. You do it because you are preparing for the next decade of dominance.
I disagree. I classify that as stay-in-business spending. Look, in manufacturing, there are two types of CapEx, capital expenditure. There's growth CapEx, which is building a new factory to double your output. And there's maintenance CapEx, which is replacing old machines with new ones just to keep doing what you're already doing. Automation is often a defensive reaction to rising labor costs or aging equipment. If they were spending $425 million to build a new plant in the Dominican Republic or to launch a completely new product line, I'd call that growth. But streamlining, that's defensive. Look at the Outlook section. Mr. Rawl warns of significant headwinds. He says they are taking action to minimize and mitigate. That is the language of survival, not conquest.
You are misinterpreting prudence as fear. The Outlook also states that organic, profitable, and sustainable growth remain our priority. They are talking about innovation and renovation of the product portfolio. You cannot innovate effectively with old machinery. The digitalization allows them to be agile. Agility is the ability to pivot when the market softens, to switch production lines quickly from one flavor to another based on real-time demand.
But where's that demand coming from? You're building a Ferrari engine to drive in a school zone. If the market demand is flat, agility doesn't get you more revenue. It just saves you a few dollars on the margins.
It comes from the efficiency they pass on to the customer. And let's not forget, they're doing all this retooling while paying dividends. They paid an interim dividend of 0.15 cents per stock unit. They are returning capital to shareholders while simultaneously modernizing the plant. That is the definition of a balanced capital allocation strategy.
The dividend is safe, I'll grant you that. But 15 cents isn't exactly a windfall. It feels like a bond coupon. It's safe, predictable, and boring. Which brings me to the people running the show. We need to discuss governance and sustainability. Because for all my bearishness on the growth, I cannot fault their governance.
I should hope not. This is one area where the report is bulletproof. They have a corporate governance index rating of A, with a score that improved to 85.39. In the Jamaican market, or really any emerging market, that kind of transparency is gold. It minimizes the risk for the minority shareholder. You know the books are clean, you know the board is active.
The books are clean, yes. The board is filled with stalwarts, James Rawl, Vincent Chen, Rosalea Hamilton. These are legends of the industry. But here is the provocative question. Is the governance too good? Is it too safe?
How can governance be too good? That sounds like a contradiction in terms.
It becomes a problem when it stifles risk-taking. Look at their debt profile. It's almost non-existent. Finance costs dropped 66% to just $2.5 million. They have $15 billion in equity and practically zero long-term debt. That is a fortress. Yes, but it's also a lazy balance sheet.
Lazy?
Yes, lazy. Capital structure theory tells us that a mix of debt and equity usually lowers your cost of capital. A company with this much cash flow and equity should be leveraging up. They should be acquiring competitors. They should be aggressively entering new markets. Instead, we get streamlining and strict cost controls. It feels like a board that is protecting a legacy rather than trying to build a dynasty. They are acting like a bank that sells juice.
I strongly disagree. You are applying textbook theory to a volatile reality. In a high interest rate environment, which we are definitely in, having zero debt is a superpower. While their competitors are drowning in interest payments and servicing loans, LASCO is investing $425 million from its own pocket without answering to a bank manager. That gives them strategic freedom, and their investments in sustainability, water conservation, energy efficiency, those aren't just feel-good projects. They reduce long-term operating costs.
They are safe moves. They are singles and doubles. I'm looking for home runs.
They are smart moves. Look at their partnership with Recycling Partners of Jamaica. Recovery rates over 40%. This secures their social license to operate. But let's go back to your lazy balance sheet comment. You call it lazy. The metrics call it elite. Their return on invested capital, ROIC, is 22.2%.
That is high. I won't argue that.
They generate a 22% return. A zombie company doesn't do that. A stagnant company doesn't do that. That is the mark of a high-quality compounder. Even the return on equity is 18.4%.
But the ROE is down. It was 19.8% the previous year. The trend line is tilting the wrong way.
It's down mathematically because the equity base grew so much. The denominator got bigger by 15% because they retained earnings. That is a sign of wealth accumulation, not operational failure. You are penalizing them for getting richer.
I'm penalizing them for hoarding wealth they don't know how to multiply. If they can't find a place to deploy that cash at a 20% return, the ROE will continue to slide. That is the trap of the cash cow. It eats, it produces, but it doesn't grow. If they just sit on that cash, eventually that elite ROIC reverts to the mean.
We are going to have to agree to disagree on the definition of growth. I see internal compounding, you see external stagnation.
And that is the crux of it. So let's wrap this up. I'll make my closing statement. LASCO Manufacturing is a safe stock, but safe can be dangerous. The 30th anniversary feels like a plateau. The 3% revenue growth is barely keeping pace with inflation, which means the brand is losing traction in real terms. The 54% collapse in operating cash flow is a flashing red light that suggests the earnings quality is deteriorating. You cannot cut costs forever. Eventually, you have to sell more bottles of iCool. Until I see top-line reacceleration and a fix for that cash conversion cycle, I see a company that has hit its ceiling.
And I reject the ceiling argument entirely. The 2025 annual report is a testament to resilience. In a year where the market softened and supply chains broke, LASCO delivered its highest ever net profit and EPS. They held margins steady through rigorous discipline and invested nearly $500 million in automation to lower their future costs. Their balance sheet is pristine, their governance is top tier, and they are generating a return on invested capital of over 22%. This is not a company hitting a ceiling. It is a company building a stronger floor to launch its next phase. They are a compounder, plain and simple.
A compounder with a cash flow leak.
A compounder with strategic inventory management.
We are not going to solve that one today.
No, we aren't. And that is where we leave it to you. Is LASCO Manufacturing a sleeping giant preparing for its next leap, or an aging titan slowly running out of breath?
Dig into the numbers, check the cash flow statement yourself. It's all there, in black and white.
Thank you for joining us on The Debate.
Until next time.